Welcome to The Explainer. Today we're putting on our detective hats because we're going to investigate a major tech company using a pretty legendary framework. So the company in our sights is Microchip Technology. And the big question we're trying to answer is, would one of the world's most successful investors, Warren Buffett himself, actually see this as a worthy investment? We're going to dig into the evidence piece by piece and see what we find out. All right, so let's get into the investigation. To crack this case, we're going to use Buffett's famous four-part framework. You can think of it like a checklist. First up, we've got to understand the business itself. Then we'll take a hard look at the people running the show. After that, it's all about the numbers. Do they back up the story? And finally, the big one, is the price right? Our first clue is all about the company's defense system. We need to figure out if Microchip has what Buffett famously calls a moat. That's a durable competitive advantage that protects it from all the rivals trying to storm the castle. So what is an economic moat, really? Well, think about a literal castle. The moat is that big ditch of water around it that makes it super hard for enemies to attack. In the business world, it's that special something a company has that keeps competitors away and keeps the profits safe inside. Now, this is where it gets really clever. How does Microchip build its moat? Well, for one, once a customer designs one of their chips into, say, a new car or a factory robot, it is a huge pain to switch to a competitor. It's expensive and super time-consuming. They also have this massive product catalog, making them a convenient one-stop shop. And get this, their products have incredibly long lives, meaning that revenue stream is just super stable and predictable for years. But hey, it's not a perfect fortress. While the business is pretty straightforward and has a solid track record, it's in the semiconductor industry, which is just brutally competitive. And this industry is famous for its massive boom and bust cycles, which can really put a damper on the company's ability to set prices when things get tough. Okay, on to our second clue, the people running the show. You can have the best business in the world, but if the management team is reckless, they can sink the whole ship. So we've got to figure out if these leaders are trustworthy, and more importantly, if they make smart, rational decisions with the company's money. And their track record here is actually pretty impressive. Management has shown a real pattern of smart moves. They make strategic acquisitions to grow, they buy back their own stock when it's a good deal, they've paid a dividend like clockwork for over 20 years, and they're really disciplined about paying down debt. These are all green flags pointing to a rational team at the helm. So far, so good. We've got a solid business and what looks like a capable management team. But a good story isn't enough, right? We need proof. This is where we get into the weeds and look at the hard numbers, the financial evidence that tells us what's really going on under the hood. First up, return on equity. Now, why do we care about this? It basically tells us how good management is at making money with the money we, the shareholders, have given them. For Microchip, their 5-year average comes in at a very, very respectable 18%. To put that in perspective, a lot of investors see anything over 15% as the mark of a really high-quality business. Next, just look at these gross margins. They've peaked at 65%. That's a powerful number. It means that for every single dollar of product they sell, 65 cents are left over to cover all the other costs and, hopefully, become profit. Margins this high are a huge sign that the company has real pricing power and runs a tight ship. And that brings us to the king of all metrics, free cash flow. This is the real, actual cash left over after running the entire business. It's the money they can use to pay dividends, buy back stock, or pay down debt. And Microchip? It's a cash machine, cranking out an average of $2 billion of it every single year. That's a seriously powerful engine. Okay, let's recap. The evidence is pretty compelling, right? We've got a quality business, smart management, and the financials are strong. But this all leads us to the final and honestly the most important question. Is the stock selling for a good price? To answer that, we have to look past the day-to-day stock price and try to figure out the company's true intrinsic value. Now, that's just a fancy way of saying we're going to calculate what the business is fundamentally worth based on all the cash it's probably going to generate in the future. And this is where the plot thickens. Our analysis puts Microchip's real value somewhere around $72 a share. But at the time of this investigation, what's the market asking for it? $85. So this means the stock isn't on sale at all. In fact, you'd be paying a premium. This leads us right to Buffett's #1 most important rule, the margin of safety.
It's a really simple idea. You want to buy something for way less than you think it's actually worth. That discount is your protection, your safety net, in case you're wrong or things just go bad. And with the price at 85 and the value at 72, well, that margin of safety just isn't there.
So here it is, our final report card for Microchip. It gets high marks, a B+, another B+, and an A- for its business quality, its management, and its financial strength. But it gets a C on valuation. So what's the final verdict? It's a very good company, but it's selling at a price that already reflects that quality. And maybe then some?
And that leaves us with our final thought. This whole investigation shows that Microchip is, without a doubt, a quality company. But a great investment requires more than just quality. It requires discipline. So the question you got to ask yourself isn't just, is this a good business? The real question is, at what price does this good business become a truly great investment? And that, right there, is the art of value investing.